Finovasta. Finance. Innovation. Wealth.
It's so incredibly easy to look at a green upward trending chart and think to yourself, oh yeah, absolutely, I can handle this risk, right? It's probably the most common trap for new investors jumping into the financial markets. Asking yourself, can I handle risk when markets are rising, kind of feels like the right place to start. But as Finovasta's comprehensive guide points out, that's actually a fundamentally flawed question. Let's be honest, it is really easy to be brave when literally everyone is making money.
Now here's the real question you need to be asking. What will you do if your investment falls significantly? Think about it. If a temporary dip causes you to absolutely panic and want to sell everything, well, your portfolio is likely taking on way more risk than you can comfortably handle. It's kind of like the Mike Tyson rule of investing. Everyone has a plan until they get punched in the portfolio. Flipping the script to focus on how you react to a downturn, that's the absolutely crucial first step to getting your head into the right investing mindset.
So, welcome to today's Explainer, where we're breaking down Finovasta's really excellent blueprint on how to start investing. And hey, even if you already follow the markets pretty closely, getting back to the absolute fundamentals is such a powerful exercise. You absolutely do not need to be a financial expert or some Wall Street insider to build wealth over time. Instead, I want you to think of this whole process as building a financial skyscraper. We're going to start deep underground, pour a rock-solid foundation, and then just work our way up, floor by floor.
Here's our blueprint for today's build. We've got 5 parts. First, saving versus investing. Second, the power of compounding. Third, your investing toolkit. Fourth, building your strategy. And finally, beginner mistakes to avoid.
Okay, let's dive into this with Section 1, saving versus investing, the baseline. Right off the bat, there's a hard line between these two concepts. Saving, that is all about pure protection. You're keeping your money in relatively low-risk, easily accessible accounts. So, if you need the cash for a wedding or, say, a sudden roof repair in a few months, it should absolutely be saved. Investing, on the other hand, is putting your money to work. You're buying assets that have the potential to grow in value over time while totally accepting the possibility of temporary losses along the way. If you're playing a decades, not days game to build generational wealth, that money should be invested. But listen, before you invest a single dime, you have got to pour that concrete foundation. You need to know your monthly income and expenses. And even more importantly, you absolutely must manage any high-interest debt and have a solid emergency fund in place. Think about it. There's very little benefit in aggressively investing your money if you're simultaneously dragging around expensive credit card debt. If your card is charging you 20% interest and your investments are pulling in, say, 8%, you are mathematically moving backward. So lock in that emergency buffer first. Moving right along to Section 2, the power of compounding, wealth's magic engine. Once your foundation is totally set, you get to tap into what is widely considered the 8th wonder of the world. Compounding happens when your investment earns returns, and instead of skimming those returns off the top, you leave them invested so they can generate their own future returns. It is just a massive snowball effect. You aren't just adding new money. Your previous money is making money, and then that new money is making even more money. It's wild. And this is exactly why starting early is so incredibly valuable. The more time your money has to roll down that hill, the exponentially bigger that snowball gets.
Now, a lot of folks assume they need a massive lump sum, like some huge inheritance or a fat year-end bonus, just to even get into the game. But the truth is, you can start building that snowball with just $50 a month.
Or you can start with $500 a month. The really crucial takeaway here is that the actual dollar amount is totally secondary to building the habit. Try to treat investing like a regular, non-negotiable financial utility bill, rather than just something you do when you happen to have a little extra cash lying around. Because at the end of the day, consistency beats intensity when it comes to compounding. All right, let's get into Section 3, your investing toolkit. These are your construction materials. Now that we know exactly why we invest, let's look at the actual materials we'll be using. First up, we've got stocks. And remember, you aren't just buying some random ticker symbol on a screen. You are buying direct ownership in a living, breathing business. When you buy shares, you literally become a partial owner. Stocks offer the potential for massive growth, and sometimes they even pay out dividends, which is basically your cut of the profits. But, and this is a big but, they come with concentrated volatility. A single company can absolutely skyrocket, or it can go entirely bankrupt. Next up, bonds. If stocks represent ownership, bonds are essentially IOUs. You're basically acting as the bank, lending your money to a corporation or even a government in exchange for regular interest payments and the eventual return of your initial principal. They generally carry lower risk than stocks, acting kind of like the shock absorbers in your portfolio against those wild swings of the stock market. Just keep in mind, no investment is completely risk-free. Bonds definitely still carry inflation and interest rate risks.
Then we have the ultimate beginner tool, ETFs, or exchange-traded funds. Instead of trying to pick the single winning horse, an ETF basically lets you buy the entire racetrack. It holds a vast collection of assets. We're talking hundreds of different stocks or bonds, and trades on an exchange, just like a single stock would. So with one single purchase, you get this huge, broad exposure to an entire segment of the global market. It's a total game changer.
Finally, we have mutual funds. These basically pool your money together with thousands of other investors to buy a massive portfolio of assets. They operate really similarly to ETFs in providing that absolutely crucial safety net of diversification. The main difference is just slightly different pricing and trading mechanics under the hood. And this brilliantly illustrates that age-old rule: never put all your eggs in one basket. Say investor A puts 100% of their money into one trendy tech stock. If that company goes under, they are completely wiped out. But investor B, they use ETFs or mutual funds to spread their money out across 1,000 different companies. That right there is diversification. Now, it doesn't eliminate market risk entirely, of course, but it absolutely prevents those catastrophic, unrecoverable losses.
Okay, let's move on to Section 4, building your strategy, putting all of this into practice.
So how do we actually put this into practice without getting completely overwhelmed? Well, here is your low-stress blueprint. Step 1 is your defense. Build that financial foundation of solid budgeting and emergency funds. Step 2, define your time horizon. Saving for a house next year requires totally different materials than saving for a retirement that's 30 years away, right? Then steps 3, 4, and 5 are your offense. Choose broadly diversified funds over picking individual stocks, invest on a really strict schedule, and ruthlessly keep your fees as low as possible.
Speaking of investing regularly, let's quickly contrast our two main approaches here. Lump sum investing means putting a large amount in all at once. Regular investing, which is often called dollar cost averaging, means putting in smaller amounts at very regular intervals, like say $250 every single month. Dollar cost averaging is incredibly powerful simply because it completely removes human emotion from the equation. It literally stops you from sitting on the sidelines, totally paralyzed, trying to guess the quote-unquote perfect day to enter the market.
And that brings us to Section 5, beginner mistakes to avoid. Think of these as our building code violations.
Before we put the roof on our skyscraper, we absolutely have to look out for structural flaws, because the market is just full of traps. Trying to get rich quickly? That is a massive red flag. Real investing is actually famously boring and steady. Following social media tips blindly is a total recipe for disaster. Remember, online hype absolutely does not equal investment quality. Panic selling is another huge trap. It essentially takes a temporary on-paper dip and permanently locks it in as a real-world loss. And please, never ignore fees. Even a seemingly tiny 1% management fee can literally cannibalize hundreds of thousands of dollars of your returns over a few decades. We really need to separate the whole concept of long-term investing from emotional online day trading.
I really want to leave you with this exact powerful takeaway straight from the Finovasta guide. Start small, learn continuously, invest consistently, think long-term. You don't need to know everything today, you just need to start. You need to build a disciplined financial strategy that gives your money the time and opportunity to actually grow. So, looking at your own financial foundation right now, what is the very first step you're going to take today to start building your skyscraper?